Hello, we're the Weatherhead Financial Group, and today we're going to offer a company valuation and recommendations on IT Staffing Incorporated.
My name is Daniel Chung, and I'm a sophomore at Case Western.
My name's Sam Lathrop, and I'm a junior.
My name is Matthew Biddle, and I'm a sophomore.
My name is Aiden Owens. I'm a freshman.
My name is Rohan Bhatt, and I'm a sophomore.
Now let's look at the industry insights and key trends. The U.S. staffing industry is large and expanding, generating $97 billion in revenue in 2019. It's expected to lead job growth over the next decade more than any other industry. There's a shift towards higher skilled and paid positions with a shortfall of qualified workers. IT dominates 43% of the staffing revenue. It's also critical for business operations. There's become a rise in demand for part-time IT staff as it's become uneconomical to have full-time IT staffs. The IT staffing segment is also fragmented, and the recent trend is that there have been the top three leading IT part-time companies have been acquired by the top US firms by global staffing giants.
For our fair value analysis of IT staffing, we use three different methods to project the equity value. So we use perpetual growth, EBITDA multiples, and a market range of EBITDA multiples. Our fair value for using perpetual growth came with a range centered around 250 million. Our equity value using EBITDA multiples was centered around 325 million, and market range of EBITDA multiples was around 300 million. Based on these three different types of fair value analysis, we came up with an overall range for the fair value with a minimum at $300 million and a maximum at $310 million.
To dive a little bit more into the valuation methods, firstly, we use free cash flow. We settled on a median of 5 most comparable companies beta, which ended up being 1.45. And using the same method as above, with the medians, we used 2.49% as our size premium. Both those numbers are used when we went to calculate our WACC. We had our EBITDA multiples set to 7.0 and 8.5, which are values that are highly comparable to companies in the industry. And we put our expected growth rate at 3 to 4%. Values were calculated from past performance of comparable companies and IT staffing, but we also discounted it slightly to mirror realistic expectations. For the comparable market multiples, we compared IT staffing to its 5 most similar companies and use EBITDA multiples from 0.5 to 8.5 and multiplied that by the previous year's EBITDA. Now to just go really quickly through all the 5 comparable companies that we use. The first one was Robert Half International Incorporated. What they do is they offer specific staffing technology consulting services, which is really similar to ITS. And they also have an extensive presence aligning in the US, aligning with ITS's main customer base.
Kforce Incorporated provides professional and technical staffing, and they also have an emphasis on technological roles that are similar to those filled by ITS. It's also primarily US based, which is also similar to ITS.
Next, we have On Assignment, which specializes in IT and professional staffing, offering flexible and permanent staffing like ITS. It's also focused on expanding business models like ITS.
We also use Manpower Group as a comparable. Manpower Group is a much larger company with one of the highest revenues that we looked at, and it is a global company, but because it has a large IT staffing division, we chose this as a good comparable.
And the last company we used to compare was Kelly Services Incorporated. And this company provides a broad range of staffing solutions, including temporary staffing and outsourcing services. And they also have a dedicated segment for IT staffing.
So after all this analysis, we have 3 general recommendations: maintain the status quo, restructure, or sell the company. So to talk a little bit about maintaining the status quo, why this is a good option is that it maintains the current leadership and culture within the company, and it has a continued exposure to future upside potential. However, Andy, the CFO, is unhappy in the scenario as he wishes to sell his share of the company. Furthermore, there is a risk of being consumed by competition and a risk of losing out on the cash out opportunity. Next, we have restructure. Restructuring is the course of action that we are going to suggest that this company does, because The only downside is that we must finance Andy's buyout. However, Andy will be happy with this decision because he wishes to cash out. And the other two owners of this company can have a larger stake in the company. Furthermore, there's a greater exposure to future upside potential. And yeah, so this is our suggestion. So finally, the other option is to sell. Selling realizes the profits of the company's sale. If the asking price is higher than our fair equity evaluation of 300 to 310 million, this will be very profitable. Furthermore, there are opportunities to explore new ventures for the business owners, and Andy, the CFO, is happy. However, we will lose out on the upside of this company, and David and Susan will not be happy with this option. So in conclusion, we're going to say that we should restructure.
Here is a breakdown of a restructured deal. So prior to any deal, the current equity split is David at 50%, Susan with 25% equity, and Andy with 25% equity. The restructuring deal would be buying out Andy's equity of 25%, which has a valuation of $300 to $310 million. The cost of this buyout is $75 to $77.5 million, and this buyout can be funded via a bank loan at a pre-tax rate of 6%. After this deal, Andy's equity would be zero, and his former equity would be divided between David and Susan. So David would now have 62.5% equity, while Susan would have 37.5% equity.
Now we'd like to briefly go through the appendix and show you a little bit more info on the data we use to come to our conclusions.
So first off, we have the historical and projected income statement. These numbers were previously given to us that we then did our own in-depth analysis of to form our conclusions. Then we have the historical and projected balance sheet. Like the income statement, these were numbers that were previously given to us that we used to make our projections.
Here are the data for the 11 companies that we did analysis on, and through this we determined the 5 comparable companies that we could use for our comparable company analysis with IT staff.
Here we have the 5 companies that we used for our comparable companies analysis, and we also have the EBITDA multiples, the unleveraged beta, and the size premiums for each 5. And then we were able to find the median for these values to find the best estimation of our company.
Going into our discounted cash flow analysis, this is our calculation of WACC. Like we said earlier, unlevered beta came from the median and top 5 companies along with the size premium, and that's how we calculate our WACC. For DCF, we projected out free cash flow for 4 years and used 2 types. We used perpetual growth and EBITDA multiples. For perpetual growth, it was 3.5 to 4.5%. After that, we got our terminal value and then net present value, the free cash flow, adding cash and getting rid of debt. Did the exact same thing, but with EBITDA multiples. And that's how we came to our 2 equity value ranges.
So here's how we projected the equity value using market range of the EBITDA multiples. As you can see, we had a 7 to 8.5 times market range for the EBITDA multiples, and using our 2020 EBITDA, we projected the enterprise value. Usually we would subtract off debt from this enterprise value, but because we had no debt and we had extra cash, we added the cash, which gave us the range of the equity value. So putting all that together, here's the details of the fair value analysis. Projecting the equity using perpetual growth, we got the equity value between 250 and 269.7 million, with 3.5 to 4.5 expected growth rates. Projecting it using EBITDA multiples, we got a $305 to $352 million equity value. And using the market range of the EBITDA multiples, we got a $284 to $342 million equity value.
Thank you very much.